Trade policy has thrown up quite a few surprises. The first thing is that we had expected that the repo rate will be increased given the fact that inflation has been going up, mainly on account of higher crude oil prices and the possibility of the higher MSPs leading to higher inflation. While these factors have been acknowledged by the RBI, it still feels that inflation is not going to go up, which I think is quite significant. Second, we are also expected that the CRR will be reduced by around 25 to 50 basis points given the liquidity crunch which is there right now. But it does appear that the RBI would prefer to use open market operations, whereby they purchase securities from the banks and provide them with cash in order to shore up liquidity. And the third surprise is, of course, on account of the currency. There hasn't been too much of debate or discussion on what it feels about the currency. And the primary objective seems to be inflation, which they are looking at very closely. Now, one would have felt that an increase in interest rates, besides tackling the issue of prospective inflation, would have also helped to bridge the interest rate gap which is there currently between US and India, which would be an incentive for FPIs to come into the country, or maybe the kind of negative flows which we have seen on FPIs could have been reversed in case such a thing was done. So quite evidently, I think the Reserve Bank of India is targeting inflation and making the policy accommodate inflation along with growth, and currency is definitely not primarily on its agenda. It can only be deduced that the rupee will continue to move the way in which the forces of demand and supply drive it toward the global economic factors, and there would be some limited intervention from the point of view of the RBI by selling dollars, but generally it would be more or less market driven rather than institutional driven.